We welcome our viewers around the world. In this documentary, 2025 Economic Outlook, Trends, Risks, and Regional Highlights, we explore in depth the global economic forecast for 2025. Our analysis is based on publicly available data from leading institutions, including the World Bank Group, the International Monetary Fund, and the United Nations flagship report, World Economic Situation and Prospects 2025. We encourage viewers to review these reports for a deeper understanding of the global economic projections. Feel free to navigate to the sections most relevant to your interests.
The learning objectives of this presentation, displayed on your screen, provide insights into key global economic trends and challenges in 2025, focusing on regional differences in growth, inflation, and fiscal policies across developed and developing economies. It examines the potential impact of proposed Trump tariffs on trade, inflation, and supply chains, while exploring policy responses and opportunities for sustainable growth through investment, technology, and diversification. In What's in It for You, we highlight why investing in the US economy remains a strong choice, emphasizing its resilience, innovation, and favorable business environment. The global economy remained resilient in 2024, avoiding contraction despite inflation-driven monetary tightening and multiple shocks. Growth is projected at 2.8% in 2025 and 2.9% in 2026, stable but subdued. Disinflation and easing monetary policies are expected to boost demand, though geopolitical tensions, conflicts, and tight fiscal space pose challenges. China and the US will see slower growth, with modest recoveries in the EU, Japan, and the UK, alongside strong performance in India and Indonesia. Least developed countries face a less favorable outlook, with growth forecasts slightly improving but revised downward from earlier projections. To better understand the economic outlook for 2025, it is essential to examine how the world's economies are classified. This classification is not arbitrary, but is based on key economic indicators such as GDP, level of industrialization, Human Development Index, economic structure and diversification, institutional development, poverty and inequality levels, labor market characteristics, technological readiness and innovation, macroeconomic stability, and trade and investment openness. Based on these parameters, the World Economic Situation and Prospects 2025 categorizes countries into three groups: developed economies, economies in transition, and developing economies. On your screen are developed economies, primarily located in North America, the Asia-Pacific region, and Europe. This group also includes the G7 economies, listed alphabetically as follows: Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States. The economies in transition are projected on your screen. These are located in southeastern Europe and the Commonwealth of Independent States and Georgia. A list of developing economies is projected on your screen. It includes countries in Africa, Asia, Latin America, and the Caribbean. We also provide a list of least developed countries as of December 2023. These countries are classified based on criteria such as low income levels, weak human assets, and high economic vulnerability. The classification takes into account factors including GDP per capita, nutrition levels, literacy rates, economic diversification, and resilience to external shocks. These countries face significant structural challenges that hinder sustainable development and economic growth. Let us begin with a critical metric: global poverty. The graphics on your screen illustrate progress in reducing extreme poverty and the number of people living on less than $6.85 per day. Despite efforts, poverty reduction has stalled, with 8.5% of the global population still in extreme poverty, below $2.15 per day. At the $6.85 threshold, relevant for upper-middle-income countries, 44% of the population remains in poverty, a figure unchanged since 1990 due to population growth. At the current pace, eradicating extreme poverty could take decades, while lifting people above $6.85 per day may take over a century, marking 2020 to 2030 as a lost decade for poverty reduction. For the remainder of this presentation, our discussion will cover key economic trends, challenges, and opportunities across different regions. We will examine factors driving growth, such as monetary policies, inflation trends, fiscal measures, and structural challenges. Additionally, we will highlight regional disparities, trade dynamics, and the outlook for economic recovery and resilience in the face of ongoing global uncertainties. In 2025, economic growth in the United States is expected to slow, while Europe and Japan are projected to see moderate improvements. Central banks in North America and Europe are likely to implement further interest rate cuts and ease monetary policies as inflation nears target levels. Over the past decades, productivity growth in the United States has significantly outpaced that of the Euro area, Japan, and the United Kingdom, highlighting a persistent gap in economic efficiency and innovation across these regions. The United States remains the most productive economy globally, measured by GDP per person employed. The graph tracks labor productivity measured as GDP per person employed. The US shows the highest labor productivity growth among the selected economies, with a steady upward trajectory from 2000 and a notable surge post-2020. The data indicates that the US has consistently outperformed the UK, Euro area, and Japan in labor productivity growth over the past 2 decades. This suggests stronger economic efficiency, technological innovation, and workforce productivity in the US. In contrast, the slower growth in Europe and Japan highlights structural challenges such as aging populations, labor market rigidities, and slower adoption of productivity-enhancing technologies. The proposed Trump tariffs for 2025, including a 10% levy on all imports and a 60% tariff on Chinese goods, could significantly impact the global economy. Potential trade wars may arise as affected countries retaliate, disrupting global trade and supply chains. Higher import costs could fuel inflation, raising prices for consumers and businesses. Currency devaluations, particularly from China, may lead to exchange rate volatility. Global supply chains could face disruptions, prompting businesses to shift sourcing strategies and increase operational costs. The uncertainty surrounding trade policies may deter investment and slow economic growth worldwide. While the tariffs aim to protect US industries, they risk triggering inflation, reducing global trade efficiency, and increasing economic instability. The graph compares household savings rates in selected EU countries, showing the average savings rate for 2018 to 2019, represented by blue bars, and the savings rate for the second quarter of 2024, represented by purple diamonds. The graph indicates a general rise in household savings rates across the EU in 2024, with notable variations among countries. While wealthier economies such as Germany and Sweden show higher savings rates, Southern European economies lag behind. This trend suggests cautious consumer behavior and a focus on financial security in the face of economic uncertainties. Data from mid-2024 show continued weakness in many industrial subsectors. European industries have been significantly affected by the energy price shock, weak domestic and export demand, and declining business confidence. This has led to reduced profitability and a sharp decline in investments, negatively impacting the region's productive capital stock and future output capacity. In Germany, estimates indicate a notable decline in the stock of productive capital. Africa's growth is expected to accelerate, driven by stronger performance in its largest economies. However, high debt and interest payment burdens persist despite progress in fiscal reforms and debt restructuring. Extreme poverty continues to rise, especially in least developed countries, due to macroeconomic fragility and external shocks. East Africa is set to lead growth, with Ethiopia, Kenya, Rwanda, Uganda and Tanzania benefiting from strong demand and tourism recovery. In contrast, Central Africa's growth is hindered by stagnant oil production and weak recovery in key economies. Government interest payments are expected to continue to increase in various sub-regions of Africa compared to the average in 2015 to 2019. Addressing these challenges will require a mix of policy measures, including better debt management strategies, revenue mobilization efforts, and structural reforms to enhance economic resilience and reduce dependency on costly borrowing. The increase in government interest payments will lead to 1. An increase in fiscal strain and reduced public spending. Higher interest payments will divert resources away from critical sectors such as healthcare, education, and infrastructure, limiting government's ability to invest in economic and social development. 2. Rising debt sustainability concerns, leading to increased debt servicing costs, which will heighten the risk of debt distress, making it more challenging for countries to meet their financial obligations without restructuring or seeking external support. 3. Limited fiscal space for economic stimulus. Governments may have less flexibility to implement fiscal stimulus measures needed to support growth, especially in times of economic downturns or external shocks. 4. Higher borrowing costs. Rising debt service burdens may lead to credit rating downgrades, increasing borrowing costs and reducing access to affordable financing for development projects. 5. Pressure on currency and inflation. Increased debt repayments in foreign currencies can exert pressure on local currencies, leading to depreciation and contributing to inflationary pressures, further eroding household purchasing power. 6. Reduced investor confidence. Persistent high interest payments may signal fiscal vulnerability, potentially deterring foreign direct investment and slowing down economic growth. 7. Social and political implications. Limited fiscal capacity to address social needs may lead to public discontent and political instability, especially in countries with high levels of poverty and unemployment. While poverty rates in Asia continue to decline, the number of people living in extreme poverty in Africa is rising, based on the $2.15 per day poverty line, 2017 prices. This increase is driven by government mismanagement, low productivity, lack of innovation, wars, climate change, and the COVID-19 pandemic, which pushed an estimated 55 million people into poverty in 2020 alone, African Union data. Examples include Angola, where 7 million fell into extreme poverty between 2008 and 2018, and Nigeria, with 2 million between 2015 and 2018. Regarding the economies in transition, economic growth in 2025 is expected to moderate after surpassing expectations in 2024. Most countries in the region, except the Russian Federation, have seen declining inflation, allowing central banks to ease monetary policies. However, in Central Asia, climate-related challenges and energy shortages are becoming major obstacles to sustained economic growth, posing risks to long-term development and stability. Most countries in economies in transition experienced declining inflation, which allowed for monetary easing through lower policy rates. Unlike other countries, Russia faced rising inflation, leading to an increase in policy rates to counteract inflationary pressures. The significant rate cuts in Kyrgyzstan, Ukraine, and Armenia suggest a response to cooling inflation, supporting economic growth through lower borrowing costs. This data indicates a general trend of easing monetary policies across the region, except for Russia, where inflationary pressures required tightening measures. Economic growth in 2024 exceeded expectations in most Commonwealth of Independent States and Georgia. Russia maintained strong growth in the first half of the year, driving regional expansion through positive spillovers. Central Asia and the Caucasus also sustained robust growth. The Commonwealth of Independent States and Georgia's GDP grew by 4.2% in 2024, but is expected to slow to 2.5% in 2025 due to a projected Russian slowdown. However, sectoral variations are not reflected in headline figures, and risks from the war in Ukraine and geopolitical tensions persist. The invasion of Ukraine by Russia has adversely impacted trade in the region. Total imports into Ukraine has reduced compared to levels before the conflict. Total exports and agricultural exports have also declined. The region, East Asia, has sustained steady growth, driven by improved merchandise trade and resilient private consumption. Easing inflation has allowed for more accommodative monetary policies, while fiscal consolidation efforts persist. However, downside risks include weaker external demand, escalating trade and geopolitical tensions, and climate-related disasters, which could undermine the region's economic stability. Economic growth in East Asia remained strong in 2024, surpassing other developing regions and contributing significantly to global expansion. However, growth is expected to slow slightly from 4.8% in 2024 to 4.7% in 2025. Mainly due to China's economic deceleration. China's GDP growth is projected to moderate from 5.2% in 2023 to 4.9% in 2024 and 4.8% in 2025. Early 2024 saw strong consumption and property sector growth, but both weakened later amid slowing disposable income growth and low consumer confidence. The majority of exports from East Asian countries go to other countries in the region. Most of the exports from China go to other countries, with little going to the United States and the European Union. With the exception of Cambodia and Vietnam, exports to the United States are modest. The majority of exports are machinery and electrical equipment, with the Philippines leading in this category, followed by Singapore, Malaysia, Vietnam, and China. Cambodia leads in the export of textiles and footwear, followed by Vietnam and China. Economic growth in South Asia is expected to remain strong in 2025, led by India's robust performance. Inflation, which eased in 2024, is projected to decline further, allowing central banks to cut interest rates and ease monetary policy. However, fiscal challenges persist, with public debt levels among the highest globally. Regional GDP grew by 5.9% in 2024 and is forecast to expand by 5.7% in 2025 and 6% in 2026. Driven by India's growth and recoveries in Bhutan, Nepal, Pakistan, and Sri Lanka. In South Asia, general government gross debt as a percentage of GDP is projected to keep going in a downward trend, which leaves room for economic growth in the region. This ought to be reflected in lower prices in food and essentials for daily living, further spurring growth in the economy. In South Asia, regional inflation is expected to decline from 9.9% in 2024 to 8.3% in 2025 and 7.2% in 2026. In India, inflation is projected to ease from 4.8% in 2024 to 4.3% in 2025, staying within the central bank's 2 to 6% target range. Falling energy prices have helped, but adverse weather drove up staple food prices in 2024, causing spikes in June and September. Inflation fell in most South Asian countries except Bangladesh, with 2025 rates ranging from 3.1% in Sri Lanka to 28.4% in Iran. In Western Asia, escalating conflicts and stagnant oil revenues have slowed the region's growth, which remained at 2.0% in 2024, but is expected to rise to 3.5% in 2025 with higher oil production and diversification efforts. Turkey's growth slowed to 3% in 2024, with risks from weak consumption and output. Saudi Arabia grew 1.1% in 2024, with 4.4% growth forecast in 2025 under Vision 2030. Conflicts have worsened crises in Palestine, Lebanon, Syria, and Yemen. Israel's GDP fell to 0.5% in 2024, but is expected to recover in 2025. The regional unemployment rate is projected at 9.8% for 2024, exceeding pre-pandemic levels recorded in 2019. In Turkey, unemployment has stabilized at 8.8% as of October 2024. Labour market segmentation reveals disparities, with Saudi Arabia's overall unemployment at 3.3% in Q2 2024, but 7.1% for nationals. The region has the world's lowest female labour force participation and the highest youth unemployment, with a 2023 employment rate of only 19.3% for those aged 15 to 24, excluding Israel and Turkey. Over 11 million youth, predominantly women, were included in this category in 2023. Fiscal challenges persist across the region as governments face rising spending pressures. Deficits are expected to widen from 1.9% of GDP in 2024 to 2.6% in 2026 due to limited oil output, stagnant prices, subsidies, and diversification spending. Bahrain and Saudi Arabia will maintain deficits, while Kuwait's surplus will turn into deficits in 2025 to 2026 due to infrastructure projects. Qatar will sustain a surplus with stable gas production. Turkey's fiscal reforms aim to reduce deficits and curb inflation. The economic outlook for Latin America and the Caribbean is moderately favourable, supported by strong private consumption, easing monetary policies and higher exports. However, per capita GDP has stagnated for over a decade, hindering progress on sustainable development goals. High public debt and restrictive monetary policies continue to limit the region's capacity to tackle long-term economic challenges. The short-term economic outlook for Latin America and the Caribbean is moderately favourable, with GDP growth expected to rise from 1.9% in 2024 to 2.5% in 2025, surpassing the 2010 to 2019 average of 1.7%. Growth is driven by strong private consumption, easing monetary policies, and improved exports. Brazil's steady growth and Argentina's recovery will support momentum, but risks from slowdowns in China and the US remain. The short-term economic outlook for the region is mixed. In Brazil, GDP growth is expected to slow from 3% in 2024 to 2.3% in 2025 due to tighter monetary policy, reduced fiscal spending, and weaker exports, though private consumption remains strong, supported by a robust labour market and social spending. Poverty fell to 16.1% in 2023, and tax reforms in 2026 may boost future investments. In Mexico, growth is projected to decline from 1.6% in 2024 to 1.3% in 2025 due to weak consumption and fiscal consolidation, despite benefits from US policies and nearshoring. Argentina is recovering with investment in key sectors but faces record-high poverty. In the Caribbean, GDP growth is estimated at 2.5% for 2024 and 2025, insufficient to address development challenges. What's in it for you? It's essential to prioritize your own economic well-being. To make informed investment decisions, you should independently assess the performance of your country's stock market over the past several years, with a particular focus on the most recent year, and evaluate the economic outlook for 2025. For instance, investing in the US stock market appears to be a viable option for several compelling reasons. 1. Resilient economic growth and market stability. Despite global challenges, the US economy demonstrated robust growth in 2024, with GDP increasing by 2.8%, surpassing expectations. This resilience, supported by strong consumer spending, public investment, and a dynamic labour market, positions the US as a stable and attractive investment destination in 2025. 2. Technological innovation and leadership. The US continues to lead globally in technology and innovation, with thriving sectors such as artificial intelligence, clean energy, and biotechnology. Investments in research and development, along with supportive policies, create opportunities for high returns in cutting-edge industries. 3. Favorable business environment and policy support. The anticipated easing of monetary policy, along with fiscal incentives for infrastructure, green energy, and manufacturing, offers a conducive environment for businesses. Lower inflation and interest rate cuts are expected to enhance credit conditions, boosting corporate profitability and investment opportunities. In summary, the global economy in 2025 is poised for gradual recovery, with strong growth in South and East Asia driven by robust domestic demand and easing inflation. Europe and Africa are expected to see improvement, supported by diversification efforts and increased investment. While challenges such as poverty, fiscal pressures, and geopolitical risks persist, easing monetary policies, strong labour markets, and expanding trade present a positive outlook. We also highlight key reasons the US economy remains a sound investment choice, emphasizing its resilience, innovation, and favorable business environment. The learning objectives have been met. Thank you for watching.
If you enjoyed this video, don't forget to like, share, and subscribe. This has been a presentation of Apomulero Media LLC. By subscribing, you ensure you don't miss out on our future videos that delve into fascinating topics from around the world.